Every year, hedge funds manage over $4 trillion in assets. They are the most aggressive, secretive, and misunderstood vehicles in all of finance. Not mutual funds, not index funds, something far more complex. In this video, we break down exactly what a hedge fund is, how it makes money, what strategies it runs, and why most investors can never touch one. This is how hedge funds actually work. A hedge fund is a private investment partnership. It pools capital from wealthy individuals and institutions, then deploys it using strategies that would be illegal or unavailable to ordinary mutual funds. The name comes from hedging. Originally, the idea was to offset long positions with short positions to reduce risk. Today, many hedge funds do the opposite. They use leverage, derivatives, and complex strategies to amplify returns. Accreditation requirements mean you typically need a net worth over $1 million or annual income over $200,000 just to invest. These funds are not registered with the SEC the same way mutual funds are, which gives them enormous freedom and enormous risk. The classic hedge fund structure is a limited partnership. The general partner, the hedge fund manager, runs the fund and makes all investment decisions. The limited partners, the investors, provide capital but have no say in day-to-day operations. The fee structure is famously called 2 and 20. 2% of assets under management per year, regardless of performance. 20% of any profits generated. So on a $1 billion fund that returns 20%, the manager earns $20 million in management fees, plus $40 million in performance fees. $60 million in a single year. This fee structure has made hedge fund managers some of the wealthiest people on earth. There is no single hedge fund strategy. There are dozens. Long-short equity is the most common, buy undervalued stocks, short overvalued ones. Global macro funds trade currencies, interest rates, and commodities based on economic forecasts. George Soros famously broke the Bank of England in 1992 with a global macro bet. Event-driven funds target mergers, bankruptcies, and spin-offs. Quantitative funds use algorithms and statistical models. Renaissance Technologies ran the Medallion Fund, which returned over 66% annually for decades. Distressed debt funds buy the bonds of bankrupt companies at steep discounts. Multi-strategy funds combine several of these under one roof. The common thread? Every strategy tries to find alpha, returns above the market. Hedge funds amplify their bets with leverage, borrowing money to invest more than they have. A fund with $1 billion in capital might control $5 billion in assets. 5-to-1 leverage. When their trades work, returns are spectacular. When they fail, the losses are catastrophic. In 1998, long-term capital management, run by Nobel Prize winners, had over $1 trillion in exposure on less than $5 billion in equity. When Russian debt defaulted, the entire firm collapsed in weeks. The Federal Reserve had to orchestrate a bailout to prevent contagion. Leverage is the amplifier that makes hedge funds both extraordinary and dangerous. One of the most powerful tools hedge funds have is short selling. You borrow shares of a company, sell them immediately, and wait for the price to fall. When it does, you buy them back cheaper and return them, keeping the difference as profit. If the stock rises instead, your losses are theoretically unlimited. In 2021, Melvin Capital shorted GameStop. Retail traders on Reddit coordinated a short squeeze, driving the price from $20 to $480 in days. Melvin lost 53% in January alone and eventually shut down. Short selling is one of the most controversial and most essential tools in finance. It disciplines overvalued stocks and rewards research. Here is the uncomfortable truth about hedge fund performance. The majority of hedge funds do not consistently beat the S&P 500. Warren Buffett bet $1 million in 2007 that no hedge fund could outperform a simple S&P 500 index fund over 10 years. He won. The hedge fund portfolio returned 22% over the decade. The index fund returned 85%. Yet the very best hedge funds, Citadel, Millennium, Renaissance, have delivered extraordinary returns for decades. The industry is bimodal. Elite managers produce generational wealth. The majority collect fees while underperforming. Selection matters more than the asset class itself. Hedge funds are not for most investors. The fees are high, the minimums are enormous, and the average fund underperforms the index. But at the elite level, they represent the most sophisticated capital allocation on the planet. Using leverage, short selling, global macro bets, and quantitative algorithms that no individual investor could replicate alone. The 2 and 20 model, the LP structure, the strategies, the leverage. Now you understand what is really happening when trillions of dollars move in the shadows. If this video gave you a clearer picture of how hedge funds actually work, subscribe and hit the bell. We cover markets, money, and finance every week. See you in the next one.